Hey everyone, Emily Carter here. If you've ever looked at company shares online, you might have seen the terms common stock and preferred stock. But what do they actually mean? And which one's better for you as an investor? Today, we're breaking down the real difference between the two. Who gets to vote, who gets paid first, and why both types of shares exist in the first place. Let's make it simple. When you buy a company's stock, you're buying ownership. That means you literally own a small part of that business. But not all ownership is the same. It depends on the type of stock you hold. Common stock is what most people buy. It gives you ownership, the right to vote in company decisions, and a share in profits. Preferred stock, on the other hand, is a bit different. It's more like a blend between a stock and a bond. You usually don't get voting rights, but you do get priority when it comes to dividends. One big advantage of owning common stock is that you get a voice, literally. Common shareholders can vote on company decisions like electing the board of directors, approving major mergers, or even executive compensation. Each share usually equals one vote. So if you own 100 shares, you get 100 votes. It's your way of having a say in how the company's run. Preferred shareholders, though, typically don't get that right. They're investors, not decision makers. Their main focus is stability and predictable income. Now, here's where things get interesting. Dividends. Both common and preferred shareholders can receive dividends, but the timing and priority are completely different. Preferred shareholders are first in line. That means before any common shareholder gets a dime, preferred shareholders must receive their full dividend payments. And the amounts are often fixed, like a bond coupon. Common shareholders, on the other hand, get paid after preferred shareholders, and their dividend amount can change depending on company performance. In good years, it might rise. In tough years, it might shrink or even be paused. So if you want more stability and predictable income, preferred stocks can feel safer. But if you want growth potential and the chance to benefit from rising profits, common stock offers that upside. Think of it like this. Common stocks are for investors who want long-term growth. The value can swing up and down, but over time, strong companies tend to rise in price and often increase dividends. Preferred stocks, on the other hand, are for those who value stability. They're less volatile, and their fixed dividends make them attractive to income-focused investors, like retirees. However, preferred shareholders usually don't benefit if the company's stock price skyrockets. They get steady income, not explosive growth. Many big companies issue both types. Banks like Bank of America or J.P. Morgan Chase and telecom giants like AT&T often use preferred stock to raise money, offering fixed returns to investors who want steady income. Meanwhile, their common stock trades actively on exchanges like the New York Stock Exchange or the National Association of Securities Dealers Automated Quotations, where prices move daily based on demand. So here's the big takeaway. Common stock gives you ownership, voting power, and long-term growth potential. But it comes with more risk. Preferred stock gives you stability, predictable income, and priority on dividends, but without a voice in company decisions. Both have their place, depending on your goals and risk tolerance. Some investors even combine both, using preferred shares for income and common shares for growth. In our next lesson, we'll dive into the different types of stocks by investment style, growth, value, and dividend stocks, and how to balance them in your portfolio. So make sure you're subscribed, because this is where your understanding of smart investing really starts to take shape.